Silver production hit the top of guidance and free cash flow came in at $344 million in the peak tax quarter. But management just quietly walked full-year gold production to the low end of the range. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Pan American Silver gets graded and traded. Alright, on the top line, revenue came in about 2% below what analysts expected. That's actually a small miss for a company where the price of silver just more than doubled year over year, meaning the analyst bar coming in was set very high and they just barely didn't clear it. And on the earnings side, EPS missed by about 13%. EPS is what Wall Street grades a company on. And when the setup was this favorable, with metals prices exploding, a miss of any size on the bottom line gets Wall Street's attention. So, on the beat itself, this earns a D. When silver prices doubled and gold prices ripped and the company still couldn't clear the estimates on either line, that's a real disappointment against the setup. The size of the misses isn't massive, but missing on both lines in a quarter this favorable is a D. And on consistency, this also earns a D. The track record of clearing estimates hasn't been reliable enough to give management the benefit of the doubt, and missing both lines this quarter reinforces that pattern. Let's talk about the positives from the report. Revenue nearly doubled year over year, jumping from $812 million a year ago to $1.12 billion this quarter. The reason is simple. The price they got for their silver went from about $33 an ounce last year to almost $71 an ounce this quarter. When your product more than doubles in price, the money flows straight to the top line. They generated $344 million in free cash flow this quarter, which is the actual cash left over after paying the bills. Here's why that's a big deal. This was also the quarter they paid $205 million in taxes, which management called the peak tax quarter for the year. So the next two quarters should convert even more of the revenue into actual cash. They returned a record $300 million to shareholders in a single quarter. $224 million of that was buying back their own stock, and $76 million was paid out in dividends. That's the highest quarterly return in the company's history, and it tells you management would rather buy their own shares at these prices than sit on the cash. The balance sheet is in fortress shape. They've got $1.8 billion in cash sitting on the books, and their total available borrowing capacity is $3.2 billion, against only $841 million in total debt, meaning they've got roughly 4 times more available cash than they owe. That kind of balance sheet lets a company keep buying back stock and investing in projects, even if metal prices drop. And their silver business is executing well. They produced 6.47 million ounces of silver, which hit the high end of what they told everyone they would produce. And their all-in cost to mine each ounce was $17.80, which came in below their annual target. Producing more than expected at a lower cost than expected is exactly what you want to see from a mining company. So on profitability, this earns an A-. The silver franchise is running below its cost guidance while producing at the top of the range, and the cash engine is even stronger than it looks because Q2 was the peak tax quarter. That combination is genuinely excellent. Now, let's talk about the negatives from the report. Gold production came in at about 166,000 ounces, which was below the range they told everyone to expect. And here's the bigger problem. Management now says full-year gold is going to hit the low end of their range, and they explicitly said next quarter's production is going to miss the low end by 3,000 to 6,000 ounces. When a company pre-announces a miss like that, it means the problem is real, and they can already see it. One of their 2 big gold mines, Jacobina, is getting guided about 10,000 ounces below the low end of its range. And the reason matters. They're changing how they mine there because of earthquake risk, which means leaving bigger support pillars in the ground and slowing down production in the highest grade areas. This is a permanent change to how the mine works, not a temporary problem they can fix next quarter. The other gold mine, El Peñón, is also getting guided about 10,000 ounces below its low end. But this one is worse. The rock formations underground just aren't as rich as the geologists expected. That's a geology problem, meaning the gold isn't where they thought it was, and there's no engineering fix for that. You just accept the mine is smaller than you thought and move on. Their cost to mine each ounce of gold ran to almost $2,000 this quarter, which was above what they expected, and they now say full-year gold costs are going to hit the high end of their range. Labor is more expensive, supplies are more expensive, and the royalty payments they owe went up because metal prices went up, so they're mining less gold at a higher cost per ounce, which is exactly the wrong direction. And they raised their expected tax bill for the year to a range of $585 to $635 million. Higher metal prices mean higher profits, which means a bigger tax bill. It's a good problem to have, but it's real cash going out the door. And on top of that, El Niño rainstorms are already disrupting site access in Chile and Argentina heading into the second half of the year. On guidance, this lands at a C-. Silver got reiterated, which is fine, but gold got walked to the low end of production and the high end of costs at the same time. And the taxes paid guidance went up. Those are all negative guidance signals hitting at once, and they outweigh the fact that silver held steady. And on red flags, I'm at a C. The Jacobina change is the one I keep coming back to. Management is already evaluating alternative mining methods with backfill, which tells me this may not be a one-year problem. It could be a multi-year grade and cost story that quietly weighs on the gold business for a while. Putting it all together, I'm giving this print a C. The silver side of this business is genuinely firing on all cylinders, and the cash return story just got materially better with a record $300 million back to shareholders in one quarter. But the gold side quietly deteriorated in ways that matter for the next two prints, with structural issues at two different mines that aren't quick fixes. The underlying business case is intact, but the near-term headline risk sits squarely on gold going into the third quarter. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. For me, the cleanest way in is selling cash secured puts at strikes below where the company itself has been buying back stock this year. That $49.22 average is basically management's own bid, and I like getting paid to buy where they're buying. I'd rather wait for the pre-announced third quarter gold miss to actually print, because that gives me fatter premium and a better strike. So my plan is simple. I sell puts under the buyback line. When I'm selling cash secured puts here, my floor is right at that $49 year-to-date buyback average because that's where the company itself is stepping in. If I want fatter premium, I'll push up toward the low $50 range near the $51.46 second quarter buyback average. But I only go that high if I genuinely want the shares, given the reiterated silver guidance and $3.2 billion of liquidity backing this thing. So my rule is floor at 49, ceiling in the low 50s. I'm holding my shares here because the release actually validates why I own this in the first place. $300 million returned to shareholders, $1.8 billion in cash, the credit facility doubled to $1.5 billion, and silver output at the top end of guidance. The gold guidance walkdown is a mix issue, not a broken franchise, so I'm not letting that shake me out. I hold the thesis is fully intact. If my covered call strikes are sitting below the mid $50 area, I'm rolling them up given how strong realized silver pricing is running. But short-dated calls in the $55 to $60 zone should just keep decaying, since nothing in this release really gives the stock a reason to gap higher near term. And if my strikes are well above my cost basis, I'm perfectly happy letting them get assigned, because the pre-announced third quarter gold miss caps the upside surprise anyway. So I roll up when my strikes sit under the mid-50s. I'm holding my leaps because nothing in this report breaks the 12 to 24 month bull case for me. La Colorada Skarn hit a real milestone with the 588 decline first cut. The credit facility doubled to $1.5 billion, and Timmins has board-approved Phase 1 investment of $146 million. The gold production problems at Jacobina and El Peñon are short-term mix issues that don't touch my multi-year silver leverage story at all. I hold the long thesis is untouched. If I'm underwater or looking to add, this release actually confirms the original reason I stepped in. The silver franchise is executing at the high end of guidance, and cash flow is accelerating now that the second quarter tax peak is behind us. Management is buying back their own stock between $49 and $51, so I want to add in pieces under that $49 year-to-date average rather than chase. I add in pieces below 49. Bottom line, this print earns a C from me. The silver franchise and the cash return story are as strong as they've ever been, but management pre-announced the next quarter's gold miss, and I want to see that hit before I get aggressive on strikes. Thanks for watching, and I'll see you on the next one.